Hello guys, greetings to you all. Welcome to another video of our IOF series. This is the second episode. But if you haven't watched the first episode, the link is on the description below. So today on this series we're talking about IOF. Okay, we're talking about IOF being being one of the first things that I look into before I can know the direction that I'm going to trade, or to know which market structure I should be looking out for, right? Remember, even in a bullish market, you can have bearish break of structure, which necessarily doesn't mean that the structure have changed. Okay, so when you are looking at IOF, you are clearly looking at where price is heading to, where the big guys are pushing price to. So when you determine your IOF, it will be very easy for you to follow market structure to these particular areas in the market. And now today we are going to start with episode 2. We already did episode 1. So like I said, if you haven't watched the video, you can watch it you take the link from the description below. All right. So today we are going to be talking based on fair value gaps, as I said on the previous video. So we're going to be talking about fair value gaps, which is the bisi and the sibi. Now, fair value gaps is just a general name for what we are going to be talking about, but under it now we have bisi and the sibi, like you can see on my screen here. The bisi here stands for buy side imbalance, sell side inefficiency, and the sibi stands for sell side imbalance, buy side inefficiency. So I'm going to be showing you all this on the charts, and I'm going to explain the meaning of it to you guys. All right, so what basically is a fair value gap, or is a bisi? All right, so a fair value gap is simply just a gap in price where the market was one-sided. Okay, but now when you come to talk about it in the side of a buy side imbalance, it is just a period where bulls they buy price up so rapidly. Okay, and then there is less sales, which leaves an inefficiency or a zone that is untraded. Okay, by price, but price will later come to these areas for liquidity to cover it up. Now, this means that if you see a big candle like this, all right, and you don't see the next candle trading back to the range of this candle, this leaves, and then the candle closes up. Okay, this leaves with also with a fair value gap, and this fair value gap, since it's in a bullish IUF, it is called a bc. Okay, so which means that actually here we're having a bc. Okay, from the low of the previous candle. Okay, let me put it down. Okay, so and this is where it starts. All right. So when you look at the range of this candle here, you discover that the wick of this candle did not trade into this area. So within this range, in this candle, only buy side was offered. All right. Only buy side trading was offered. So there is an inefficiency here. The market is not balanced. All right. So this is called a fair value gap. But in this case, it is in a bullish IF and price is seeking for buy side liquidity. It's called a bc. Right. It's called a bc. In the case of a sell side, in the case where the market is selling, we have it as sibis. Okay, we have it as sibis. All right. So at this point here, price is seeking for buy side liquidity, and when it offers an inefficiency like this, when it offers a gap like this in price, now you can look here. You see that okay, these candles here did not have basically any fair value gap. All their bodies have been traded back to with wicks and so on. But here we had this long expansion of, and price didn't trade down to it. Okay, so at this point now, what we'll be expecting is price should trade into this fair value gap, rebalance this area. Okay, price should balance this. Now, in practical ways, in every business, you need to have both buyers and sellers. Okay, if you go to a market and there are only sellers, nobody's buying, the market will not function well. If you go to the market and people are just there to buy and the stocks are not there to sell, it's not going to function well. So at this point, we need a balance. The market needs to be balanced. The market needs to be delivered efficiently. So when this inefficiency is occurred on price, price needs to trade back to it and then rebalance it before it continues its movement. Now, it could not be in instantly. There are things that you have to look into to know if price will feel it instantly or not. Like, for example, we had this inefficiency here. This is another fair value gap. You see that the wick of this candle did not trade down to rebalance this. Neither this one did not come back to close this gap here, right? So this is another inefficiency, but it wasn't filled. So why didn't it fill? There are reasons for that, okay? There are reasons for that to know if an imbalance will be filled or not. So you wouldn't have been expecting price to come down here after the invalidations have been taken, right? So just a quick one, when price takes the high of this candle, most of the time it doesn't come back to fill the inefficiency. All right, most of the time it doesn't come back to feel the inefficiency, but there are a lot of things that you try to look into to see if price is actually going to feel it or is going to continue the movement. Like, for example, here was a sell side imbalance percent inefficiency. This is a CB here, right? But you notice it wasn't filled. So what are the things? Why didn't it fill? And then it filled this one down here. Okay, so there are things that you look into to see if price will actually fill this one or it won't for the moment, right? So just like I said here, just a quick one and a simple way for you to look in, not to complicate things for you. If price takes the high of the candle that created it, most of the time it doesn't feel. Okay, most of the time it doesn't feel, like 70% of the time it won't feel again. Price will continue to look for the buy side or the liquidity that's going for. In case now, another level is if the draw in liquidity is too high, price will likely not feel rebalance it yet. It will go for the liquidity before coming back to rebalance it. Okay, if the liquidity draw is too high, right? Like here we have double tops. That's a pretty big one there. So price will try to hit for the liquidity before it comes back, balancing any unfilled areas. All right. So at this point, like I said, this is our BC, and just with the explanation I gave, I said the bulls, they push price up so rapidly that they leave an inefficiency behind. All right, that is this. I mean, at this point, it means that the sellers were not really much here. The sellers were not active, so price has to move up rapidly. And now for the market to be balanced, price has to come back down to it and then move further up for the buy side liquidity. Okay, so when you see the price traded back to the fair value gap and then it went up for the buy side liquidity. Okay, so at this level, you see here price came back down to the fair value gap, rebalanced it completely, and then went up. Now it went up again. We see another inefficiency here. Price created another inefficiency, the low of this candle and then the high of this previous candle. Now you will notice that here again, this area was not balanced, right? So price came back to it, balanced it, and then went for the buy side liquidity. Now, when it went for the buy side liquidity, what happened? The reasons why price was bullish for that moment was accomplished. So what next do we look out for? We know, like I said on the previous episode, price is always looking for liquidity, and from internal range liquidity to external range liquidity. Okay, so once the external range liquidity has been taken, price now will start looking for the internal range liquidity. And you'll notice here now that price also created here a CB. Okay, this CB now, because it's on the sell side, price is selling, and it created a rapid drop like this. And then the body of this candle, within the low of this candle and the high of this candle, there was no trading, there was no buying in that particular area. So price has to rebalance it. So price came back into the fair value gap. Sometimes it comes 50%, but once it feels this, you can go to lower time frames and you have a structural shift, and then you take your trade. All right, sometimes it feels to the 50, and then sometimes it close it completely. All right, so for you to know which level to follow is, once price enter into your fair value gap, you can go down to your lower time frame, and then you see if you have a structure shift. That's when you can take your trade, right? It's confirmed that price wants to go down. Now, this is the daily time frame. And for you to determine your IUF or your fair value gaps efficiently, you should focus more on higher time frames. Okay, focus more on higher time frames like weekly, daily, and the monthly in the 4 hour, right? Because looking at it on the lower time frames, there you are going to have a lot of fake fair value gaps. I mean, a lot of noise, right? So when you filter it to higher time frames, it helps you a lot. Okay, it helps you a lot. So just within this area, you notice that price here, it went up, gave us a break of structure here. We had a break of structure. Price came back to balance this inefficiency, right? Price came back to balance this inefficiency. It went up again, gave another break of structure, and there was another inefficiency here again. This was another BC that was not balanced. So price came to it went back up again to balance it, right? So when price took the buy side liquidity here, like I said, the reasons why price was bullish, the reasons why price was heading to this level, the liquidity has been taken, right? The liquidity has been taken. So what happens? You can see how price dropped drastically. Price dropped rapidly down, and then it created this inefficiency. And like we said, for price to be efficient, it has to be balanced. Okay, price has to be delivered efficiently. So price came back, balanced this inefficiency, and then it continued to drop. Now, this basically doesn't mean that we are already on a downtrend. Okay, it doesn't mean that we are already on a downtrend, because if you go to a higher time frame, like I said on the last video, that your IUF is determined on higher time frames. Okay, now when you look at IUF on a higher time frame like the weekly, you notice that we are only on a pullback, right? This was just a pullback that just ended. But if you were just focused on the daily time frame, you would think like, okay, you already break some structures here, you are already on a downtrend, and you start selling already. Okay, so if for that, if you would have been selling and putting your stop loss above this high, you'll see that price came up here and then it took the old high here, right? Price tipped the old high here before it started reversing. Now, this is just to help you to know that when you are determining your IAF, you look more on higher time frames. Okay, you look more on higher time frame, because the smaller time frames can be like giving you a structure shift, which yet is not, right? Because for now we are still in a bullish IAF. We are still bullish for this is GBP USD, because if you look from the weekly time frame, you will notice that we just had a break of structure here, right? And then we are pulling up to another swing high, maybe coming for this swing high now, right? But when you're looking at lower time frames, you already see like we have been bearish all these 3 weeks that were bearish here. Price has been dropping and breaking structures down, but it doesn't change the fact that we are still in a bullish IF. That's why to determine your IF, you have to stick with higher time frames. You have to stick with higher time frames. So now, how do you trade these BCs? How do you trade them? Now, like I said, you have to stick with higher time frames. Okay, you have to stick with IFs from higher time frames. Now, when you mark out your BC, let me just go somewhere like the 4 hour. When you mark out your BC on a higher time frame, what you need to do is just to go down to a smaller time frame, and then you try to figure out a structure shift. Okay, you try to look for a structure shift, and then you get your entry. Now, this is a BC here from the low of this candle to the high of this candle. This is the 4 hour time frame. Let's just go to somewhere like the 15-minute and see what we could see there for an entry. Okay, we just want to look to see if we could have a good entry from there. Now, when you look at this, you will discover that, all right, we're in a downtrend into the 4 hour BC, and then from here price gave us a break of structure. Price took liquidity down and then gave us a break of structure. So where is our entry on from this other block? So this is where you can take your entry. This is simply what I mean by going down to smaller time frames to refine your entry. Okay, because normally, like I said, price sometimes it goes right down to the fair value gap. It goes right down to the 50%. Your first target is going to be this high. Okay, so here we had a 1-to-8 risk reward ratio trade. So now when you look at it on the 4 hour, all right, when you look at this trade on the 4 hour time frame, you wouldn't have been so sure that price will just buy from the tip of this fair value gap. Okay, which means that you won't be like, okay, price will just hit this fair value gap and you start to buy. Now, the first thing that you have done correctly is that you have determined your fair value gap from a higher time frame, right? Now, the next thing that you were supposed to do is to go down to a smaller time frame now to look for an entry, to look for a structure shift. Why? Because just this pullback from here is already a downtrend on that smaller time frame. So going down to that smaller time frame now, you're going to see if you are going to have a structure shift to confirm that, all right, price is going to buy from here. So when you have that structure shift, that's where you enter your trade from a smaller time frame, just like we did here on the 15-minute time frame. Okay. And once the buy side liquidity was taken, price went down bearish. Okay. Price went down bearish. But for the moment, we're just like in a consolidation here on GBP USD. So this was just a quick example here. Know that price is fractal. What has happened here can happen on a daily. If you see this, just forget about the 4-hour. All right, this can still be the daily time frame, it can still be the weekly time frame, it can still be the 1-hour time frame. Just know that once you identify your fair value gap from a higher time frame, what you need to do is you just have to go down to a lower time frame. You just have to go down to a lower time frame to see a confirmation, right? You need a confirmation before you enter your trade. You need a confirmation before you enter your trade, which is the confirmation. We had a break of structure here. All right. We had a break of structure. Price took this equal lows here. We had this equal lows. Price took it and then it went down. Now, you notice here the price filled this fair value gap here and then bought. So this is the 15-minute. You're going down to smaller time frames, you are going to see an entry somewhere here, like the 1-minute chart, right? Because this is the 15-minute. You could see a 1-minute entry maybe from this other block here, and then price went up because we had this break of structure here. So that is simply it, guys. It's not to be complicated. Price will seek for liquidity always, right? Price is going for buy side liquidity to the sell side liquidity. And once you've marked that correctly, that's all that you need, all right? Even if you're not trading fair value gaps, once you mark out your other block, what you have to do next is just to go down to a smaller time frame to look for confirmation. Okay, to look for confirmation. So once price took the buy side liquidity, remember I said from liquidity to liquidity, when it took the buy side liquidity, we noticed that from here came in orders again that broke this major structure down here, right? So what happens is, and price even left an inefficiency here, so which means that price coming back to mitigate these orders here also have to balance this. All right, so this is going to be a high probability trade. All right, so that is how you trade, guys, with fair value gaps. This is just episode 2. We're going to continue with episode 3 and furthermore, so that will be explaining to you in details, and I'm going to explain to how you determine your IF and you trade with other blocks. Okay, how to determine your IF and trade with other blocks. But for this session, this was just how to determine your institutional order flow, and then you trade based with IF. Now, you trade based with the BC and the CB, with the fair value gaps. So in this case, fair value gaps and CBs, they are referred to as internal range liquidity. Okay, they are referred to as internal range liquidity. When the market hits, it's pushing up. When the market push ups, it leaves internal range liquidity. And this internal range liquidity, most of the time, are in the form of fair value gaps. Okay. Most of the time is in the form of fair value gaps and other blocks as well. So price always comes back for internal range liquidity, and then it pushes for external range liquidity. That's as simple as that. It's not to be complicated. All right. It's not to be complicated. This is it here. Simple. Price pushes up, it breaks structure, it left internal range liquidity, came back to rebalance it, and then it moves up. Price did the same thing here, and then it moved up. Now, when price here was selling, you notice here, right from here, right from this level here, price gave a break of structure, and then what happened? We had an inefficiency here right at the premium, right? So price came back up to it, rebalanced it, and then it sold off, heading for the sell side liquidity. That's simply how it is, guys. It's very easy. And if you cannot spot this well, there are some tools on, because there are some indicators on TradingView that you can use to spot you these fair value gaps automatically. Okay, you see how this efficiently was filled. Price, after filling this fair value gap, we had a long expansion down, and created another inefficiency. Since we're in a bearish IF, we expect it to be filled, right? We expect it to be filled. But remember, I said not all fair value gaps are going to be filled. There are things that you have to look into to know if one is going to be filled or not again, right? So this was filled. And how would you have entered a trade here? You go down to smaller time frame and you look for a structure shift, because this is on the daily time frame. Okay, so guys, I didn't intend to make this video long. If you're still watching up to now, congratulations to you. Keep on the hard work, keep on back testing. All right, you know that consistency helps a lot. Keep repeating the same things over and over again. Try to train your subconsciousness to master these things, so that immediately you look at the charts, you're already seeing them. Immediately you look at the charts, you know that this is what is happening and this is what is happening. For you to do that is only to master, it's only to back test. Look at the charts consistently, train your eyes to spot them, right? Just put in the hard work and the results are going to show off, okay? So guys, thank you guys for watching. You can share the video, like, comment your thoughts about the video, so that I can be able to make more better videos for you. Okay, thank you guys for watching. God bless you.